Hello and welcome to episode 1, Smarter Than Most in 6 Minutes, Negative Interest Rates. I'm Jason Havlin with J. Bradford Investment Management, and that's the topic we're going to cover today. So let's jump in. So first, what are negative interest rates? Well, they're as bad as they sound. Let's go through a quick example. So simple interest, or the normal interest that we all think of, let's assume a 1% annual rate, $100 that we're going to invest. You multiply the interest times the amount invested to end up with a $1 of interest. You add that to your original principal and you end up with $101. You end up with more money than you originally invested. Now, how does negative interest work? Well, the calculation's the same, but let's assume a negative 1% interest rate, same $100 invested. You multiply the interest rate, the negative 1%, times your principal, and you get a negative dollar. So when you add that negative dollar to your principal, you actually end up with $99. You end up with less money than when you started. So in the simple interest environment, you get more money at the end. In the negative interest rate environment, you end up with less money at the end. You've paid a fee or you've lost money to have the bank hold your money. And this is happening today. So how did we get here? How do we get to an environment where we have negative interest rates? Well, this has been 8 years in the making. Ever since the Great Recession and the global economic meltdown, governments have been trying to combat their slow growth by lowering interest rates and keeping them low through policies like quantitative easing and other monetary policy. And interest rates have been at or near zero for quite some time. And we've all experienced that through the very low interest rate that we're getting on our money markets, our checking accounts, our savings accounts. In some cases, it's a tenth or a hundredth of a percent, or some cases, there might not be any interest on the account at all. And that's from this generally very low interest rate environment that is pervasive across the world. Now, despite this low rate environment and that effort to stimulate economies, many countries are still facing sluggish or slow growth, relatively weak currencies, and deflation. And the prescription for all three of those problems is typically and generally to lower interest rates. So if you've got one or more of those problems, you may be inclined to continue to lower interest rates. But the problem is, if your rates are already at zero and you've got those problems and you want to take action, well, in order to get from zero to something lower, the rate has to go negative. And that's what many governments have done. So what's next? What does this mean? And how is this happening? Well, first of all, for what's next, no one knows for sure. This is a very unique and very different time. It's very largely unprecedented. Negative interest rates is not something that's happened on any sort of scale in the past, and there's not a lot of data for us to figure out what's going to happen. But it is. So last year, Switzerland successfully sold their 10-year government bond with a negative interest rate of about 0.5%. So buyers of those Swiss bonds are going to actually end up with less money at the end of 10 years than they used to purchase those bonds with. This is happening in much of Europe and Japan, but it's largely happening between banks and institutions that are borrowing and lending with each other. The consumer and the business clients have not generally felt the burden of these negative rates yet because the banks are absorbing the losses. They're treating it like a cost of doing business. And so they haven't passed that negative rate onto the customers of the business yet. So it's not really visible at the customer or consumer level yet. But if rates fall lower, or if the bank profits get squeezed enough, they may decide to take some other action or do something else. And we may see some very unintended consequences. Things like banks actually raising rates on mortgages to make up the lost profit that they're making on the overnight lending and the small term lending in their negative interest rate environment. So we really don't know exactly what's going to happen. Now, here in the United States, the Federal Reserve has indicated that they were actually intending to slowly raise interest rates throughout 2016 and into 2017. That looks to be the case, but that could certainly be reversed. Things could change, and we could find ourselves here in the United States in some kind of negative interest rate environment. And so what could or will or might happen? Again, we don't know, but a lot of us believe that currency demand and demand for hard assets like gold and real estate are both likely to rise. If you're thinking about putting your money in a bank where you're going to have less of it at the end of the month or at the end of the year, you may very well decide just to hold the currency yourself so that the $100 you put in your mattress is actually $100 at the end of the month. With gold and real estate and other investments, you obviously don't know what the value of those are going to be over time, but they are believed to be assets that in times of panic or in times of uncertain currency, the demand for things like gold and real estate do tend to rise. Again, will that happen here? We don't know. That's part of the speculation, and that's part of the debate that's happening, and we may very well find out as countries across Europe and Japan experiment with rates going even farther into the negative territory. So, if you would like to discuss negative interest rates in more detail, or if you have any questions about what we discussed here, please feel free to schedule a free consultation with Jay Bradford Investment Management. You can visit us at jbradfordinvestments.com, or you can give us a call, 603-438-1874. Thank you very much, and we'll see you next time.